Hello, it's Tuesday the 2nd. I'm FX Plu, and this is the market brief. So, as is so often the case, leaked details are already emerging from Sunak's budget. It looks like the emphasis will be on welfare support and ensuring that the recovery can flourish. The current vaccination rate suggests more than 25 million jabs will have been done by month end, and the success of that programme may mean that the economy will be well on the way back to pre-pandemic levels before any of the inevitable tax increases need to figure. Be interesting to see how much tax is mentioned tomorrow. All this helps fuel the growing sentiment that the UK will emerge from this relatively strong compared to other G7 nations. But meanwhile, the negative rate debate, it rumbles on in the background. Yesterday we had Deputy Governor Dave Ramsden on. He spoke of how the modelling and all the testing was no more than contingency planning. He remains concerned about the inflationary effect that negative rates could have by turning most of the savers into spenders. However, the market is less sensitive to comments about policy these days, and it's the vaccine-fueled recovery story that remains the main driver for sterling. That suggests that the recent fall against the dollar is no more than a correction, and that we will probably go again with the right catalyst. Who knows, that may be a disappointing number on Non-Farm Friday. Watch this space and join the sweepstake. For now though, the correction is very much still in play. We slipped to a low of 138.70 against the dollar as the dollar reacted well to Biden's support package, and that's about the level that we opened this morning. The US is adding reason to expect a renewed sterling rally, with a growing belief that the strong dollar policy isn't all that suitable these days. With the growing importance of improving the employment numbers, the manufacturing sector is likely to only remain a minor creator of new jobs, while domestic industry is still dwarfed by overseas imports. And rebalancing the higher cost of domestic production is no easy fix. Think of the unions. But a weaker dollar, well, that will at least level the playing field slightly by increasing import prices. Do you think that could be enough to encourage a renaissance of US manufacturing? Well, it's a long shot, I'll grant you that, but perhaps not one to discount straight away. Over in the Eurozone, the ECB has been on with a bit of doom and gloom. Make no change there. They've acknowledged that the Eurozone economy will take longer to recover than other G7 nations, and the recovery may not be as strong. A little minor ray of light for the central bank, though, was the single currency has continued to weaken. Euro-dollar fell to 120.15 yesterday, and we opened even closer to the 120 level this morning. Right, that's it from me. Have a great day. Join me again tomorrow.
If you do not have a clue, then just tweet through and ask FX Blue.